There has never been this much complacency before, ever. Hang on tight. You came here for the truth. I'm going to give you the details you need to know. Number one, we are going to talk about the elevated risk that's in the market today. The second thing I want to look at is the unpaid debt. Guess what? It's continuing to mount. The third thing I want to look at is the weakest link right now today. If you stay with me until the end of the video, I'm going to show you what the weakest link is today. I'm going to give you the data surrounding that as well. There's so much to cover. Let's begin. I thought it would be appropriate to begin with this article here and just touching on one point: the dangers of endless quantitative easing. The person writing this article is the former governor of the RBI, the actual central bank of India. And he's basically saying that these people that are getting into this business are not exactly seeing the future risks, and they know this, and yet they're doing it anyway. They're kind of backed into a corner. And that's generally the consensus here. We have nowhere else to go but up, simply because this is how they are stuck. Well, maybe that's not the case. Maybe it is. Only time will tell. I wanted to show you this. From reflation to capitulation, growth optimism has declined sharply in the second quarter. This comes out of Goldman Sachs. They're pulling the data, of course, elsewhere, but they're putting this together. And I think the risk appetite indicator, RAI, can tell you something about what the investors are thinking. Now, you're going into 2021 and everything is looking fantastic. It's looking fantastic. But as we come towards, the end of the second quarter, things have really changed. A lot of that has to do with inflationary pressures. It's putting a lot of, we'll talk about it in a minute here, but it's putting a lot of unneeded expense in these companies today that, of course, hits their bottom line. Elevated valuations coupled with fading growth optimism or rising volatility can increase equity drawdown risk. For all people who don't know what that means, quite frankly, when you got problems, you've got risk and fragility bringing in the potential for deflationary pressures on prices, and that is asset prices. Because whenever anything rises too fast, it can generally come down, in fact, at a much faster pace. Look at the days since last correction. I want you to note that the record right here was back in 2017, because throughout the entire year, it just kept going up and up and up and up and up. There was no stopping it. But of course, we had January 2018 into February that really changed that quickly. Now, today, we are at one of the highest ever we've seen before. And this is coming, of course, because of all the stimulus, because of all the quantitative easing and so on. Now, what does that mean for you? We will get into the Money GPS insights in a moment. Trust me, stay with me. I'm going to show you, I'm going to break it all down, but I need to get into the details here. Look, US and German 10-year real rates are at all-time lows. Look at it. It's in the negative. Germany's 10-year is minus 2% approximately. And you look at the US 10-year, it's minus 1%. That's what you're getting when you look at these. And of course, that makes people want to get into, higher risk assets like equities. But there are other much higher risk assets that people are buying up today too. Stay with me. Hang in there. Look at this. These are the big four banks, total loans and deposits. And you will see for yourself that the deposits, the green line, has accelerated. Okay, more people, they're parking money at the banks. But the loans, it has not accelerated like this, and it's been that way since the financial crisis. What's going on here? The banking system is dealing with a whole bunch of different pressure. Here you can see, going through all the different types here, this is the net percentage of domestic respondents, tightening standards for commercial industrial loans, small firms, consumer credit, so on. The direction, while in, let's say, 2020 was tighten everything up, tighten your belts. Now, 2021, it's loosened them big time. And you are seeing that across the board. The banking system is trying to elevate the amount of debt that's out there. Now, you do have a few examples, like, for example, Wells Fargo, that had closed the credit lines. Now, they do that for their own reasons. We don't know what's going on behind the scenes, but you can see for yourself. This is the revolving consumer credit, owned and securitized. You look at credit card debt, and you can see what's been happening. All right, just showing you the fact that 2020, this came down. Why? Why was that the case? Let me point that out in a second. I just want to show you the fact that that has started to pick up. We'll see the trend if it continues in this way. But I wanted to talk about this for a moment. You are seeing this right now, a deleveraging that occurred. Part of that was because people did not have to pay their credit cards for this, did not have to pay their mortgages, their rent, because they had the moratorium. So they just started paying down the higher rate of debt. That is credit cards. And of course, things are changing now with the rent moratoriums. They're changing with people going back to work in many cases. Things are different, no doubt. But look at this. Essentially what we're seeing is the amount of debt that's out there in terms of residential mortgages, and it has accelerated beyond anything we've seen before. This right here comes directly from the Federal Reserve's website. If you are new to the channel, you will note that on this website, I only give you statistics directly from the sources themselves. You don't have to believe me, you don't have to trust me, you don't have to care about me. All you have to do is understand that this channel, the Money GPS, brings you the details you need to know right from the horse's mouth. I'm calling it tomorrow's news today, and I hope you appreciate it. Take a look at this. If you want, the statistics are right there. Essentially, what you need to know is that the amount of mortgage debt outstanding continues to increase. And of course, that is never a good thing. Number one, markets today, right now, are watching for patterns of elevated risk. Number two, the banks are loosening their lending restrictions, trying to juice it up. Number three, if you are looking into perhaps investing at this time, I believe people should be setting up swing trades, short-term, temporary trades that can capitalize on the events of volatility, and that's probably the best place for people right now today. America should be a nation of renters. This right here is out of Bloomberg. It's connected with this article. Home ownership can bring out the worst in you. It's the biggest thing you might ever buy, and it could be turning you into a bad person. This is what they're saying. These type of articles are everywhere. Now, if you own a home, if you don't own a home, that's completely up to you. But we need to understand, why do homes cost so much? Why does everything cost so much? Oh, sure, there's supply chain problems. There are always going to be disruptions. Getting products to you might be more expensive. Wage increases for certain people. All kinds of things. It could be a million different things. But underlying all of that is the activity of the central bank and what they are doing. You must remember that to address the root cause of what's happening, and not simply say that you should be a renter, you should not be a renter. That should be up to you to decide, not the central bank. Now, this was a stock that got hit pretty hard. Clorox stock hit as demand for wipes and disinfectants wanes. It fell 17%. This one particular stock that was 1 year ago was just rocketing so much higher. Now, it doesn't mean that tomorrow this thing is going to disappear. Absolutely not. But it shows you, what this does teach us here is that when you have inflationary pressures, when you have disruptions, it could result in a huge swing in the price of your stock, therefore your portfolio, and of course, all that's connected with it, your retirement and so on. I found this to be very interesting, wanted to bring it to you. European natural gas price surged to a record high amid a drop in Russian supply. So of course, you know the way it works is as they talk about Yamal right here, and I think they're bringing up, the Yamal Europe link. So that's this pipeline coming across, going all the way to Germany, and this just shows you that essentially what happens when there's a disruption. Russian gas flows from Yamal suddenly dropped over the weekend. Europe is running out of time to refill inventories ahead of the winter. It's not something that you just flip a switch and it happens, right? The amount of gas entering Germany at the Malnau compressor station has suddenly dropped, signaling Russia is flowing less through the Yamal Europe link. Meanwhile, none of the fourth quarter capacity to flow more gas to Europe via Malnau was booked in an auction on Monday. So something's going on. Maybe it's temporary, but we'll see. So this is, of course, going to have an impact on that commodity. Okay? I'm giving you gold here, guys. Americans are willing to take pay cuts to never go into the office again. Here we have the weakest link. In my opinion, right now, today, the weakest link is number 1, office space, number 2, retail. How they've survived to this point, I have absolutely no idea. Take, for example, you look at any of the very big, your downtown core, your financial sectors, you got the big towers. All in these towers here, they're starting to shrink down the amount of real estate that they need. Their people are working from home. As you can see, the proof right here, people will take a pay cut to work from home because they don't have to worry about transit. They only need one car in the family now. They can get up 15 minutes before they need to be working. They can work with just their underpants on. I mean, there's a lot of things that people are loving about this, right? What does that mean though? What does it mean? It means that the real estate isn't needed. It means that all the businesses that are surrounding, if they survived, are surrounding these big towers and all these big businesses won't be needed, or not as many of them are going to be needed. And then that's going to put pressure on those businesses and so on and so on. Look at this. Solid U.S. factory orders, business spending on equipment point to enduring manufacturing strength. I thought this was good. I just wanted to note something that a lot of businesses today, this is the chart by the way, a lot of businesses today are purchasing for the future, believing that, okay, if I don't buy it today, this is shortages and everything, I'm just going to buy it right now. So you're buying now to essentially, I was going to buy it next year, but you know what, I'm just going to buy it now kind of thing. That's sort of, I don't want to say fake demand, but certainly we will see what happens in 2022. Is that still the situation? We only know as time goes on. My friends in Australia, look at this. This is interest rates. You can see the direction over the past, 25 years or whatever I pulled up here, and it just shows you it's been going down, 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 down. We've heard that before. This just gives you an idea that as they say right here, the central bank reiterated it will not increase this interest rate until inflation is within the 2 to 3% target range. Australia is doing the same thing as the US, is doing the same thing as Canada, and everybody else. They're all doing this same silly thing. Bitcoin traders eye scary retreat after return to recent range, but I do agree with the first point that says this is part of a regular rally. It goes crazy, oh my goodness, then it retreats a bit, and then it rallies, and then it retreats a bit, just like stock markets do the same. We have to look, of course, at the top level, is this bullish overall? You look at the technical indicators and you're smart with it. That's why I say, and I said in the Money GPS Insights, if you're looking at this as a swing trader, suddenly the mentality is very different. All right. If you're going to be in these certain things for 2 days, 2 weeks, 2 months, it's going to be a lot different than somebody who's trying to do long-term investing, who's probably interested. Hopefully, if you're a long-term investor, you're interested in the dividends, not just the appreciation, because a long-term investment is a very difficult thing. It's much more difficult than people make it out to be. I'm going to end the video there, but I want to ask you, if you think that this is good information, the only way you're going to be able to know for certain that you're going to get it is if you get onto the insiders. I do this for you that we can connect together. You and I are building up this channel, and we need to get past the algorithms that have clearly shunned this particular channel. I'm telling you right now, I've gone through everything, but I'm now posting approximately 50 different content pieces around the different platforms online, trying to boost this channel up. And you could help me out by getting on the Insiders. It's totally free. When we bring in the external traffic, it helps to pump up this algorithm. If you could do that at themoneygps.com or this card right here, check it out. All right, thank you very much. And of course, hit that like button. That helps the algorithm. You don't have to share it with your uncle and your brother and your neighbor. You got to hit that like button, because that's going to signal to the algorithm that this is good stuff. If you haven't seen this video already, you definitely want to check it out. Click it and I'll see you there.